right? So if you're in Turkey, you want dollars or gold or Bitcoin or whatever the case may be. If in the U.S. you have dollars, so stable coins are less of an issue. But what these technologies do is they allow people more freedom of choice in whatever country they're in. They're able to go outside of their borders and get assets or get monies that they can't get just purely internally. And so it's basically the biggest tool we have against basically a complete kind of replay of prior fiscal dominance periods or the effectiveness of capital controls. And I think it's worth defending.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
Well, I think that, for example, Bitcoin and stable coins are a big tool against this, right? So, for example, in developing countries, the fact that people can, a Nigerian graphic designer could hold up a QR code on a video call or send me a payment string, an email or a DM, and have me pay her in whatever currency she wants, right? It goes around her local banking system, right? So that's a super powerful tool. That's one that's infinite value density through ports of entry, and that's infinite value density peer-to-peer rather than through these centralized gateways. So that is basically the biggest tool against this. Is basically holding those assets, being able to transfer those assets is super important, which is also why you have to pay attention to jurisdictional risk. So I think that that's why part of my kind of case for being structurally long Bitcoin is this fiscal dominance environment. And then I do also pay attention to stable coins, especially in that kind of emerging world phenomenon, because everybody wants to go up the stack.
Cryptocurrencies, with Bitcoin and stable coins at the forefront, are emerging as influential tools in overcoming financial barriers in developing nations. These digital currencies facilitate seamless cross-border transactions, providing a crucial solution for regions where traditional banking systems are either inefficient or inaccessible. By enabling quick and cost-effective transfers, cryptocurrencies are empowering individuals and businesses in these countries to participate more fully in the global economy. However, as the use of cryptocurrencies expands, it becomes increasingly important to be aware of jurisdictional risks associated with them. Different countries have varying regulations and stances on digital currencies, which can significantly impact the ability to transfer assets across borders. Navigating these legal landscapes requires careful consideration to avoid potential pitfalls. The future of cryptocurrencies is promising, but their successful integration into the financial systems of developing nations will depend heavily on a clear understanding of these jurisdictional dynamics. By being mindful of both the opportunities and challenges presented by cryptocurrencies, stakeholders can better leverage their potential while mitigating associated risks. This balanced approach will be essential for maximizing the benefits of cryptocurrencies in promoting economic growth and financial inclusion in developing regions.
My base case is to see a more multipolar world. So you asked before, for example, what does this look like for other countries? Well, partially depends on how effective they are at getting out of the problem. So to the extent that, for example, China can buy oil in its own currency, allows them to escape some of the downsides of U.S. fiscal dominance than if they were stuck buying oil in dollars while the U.S. is running a fiscal dominance playbook. And so over time, I think you probably would see more kind of bilateral trade agreements between large foreign countries, other economic blocs. But I don't expect, for example, any one of those currencies to become larger than the U.S. currency. They're either, the only economy at the same scale of the U.S. is China, and they've closed capital, kind of on their border. And generally they're not a super trusted kind of global partner. And so it's not that one other big currency takes over, but that you have a little bit more diversification of currency pricing or what kind of reserve assets central banks hold. So you get maybe less treasury purchases and more gold purchases because that's a market that they're used to. It's pretty big. Over time, we'll see, for example, what happens to the size of the Bitcoin market in 5 or 10 years or whatever else is happening here. Stable coins are an interesting variable because even as you have top-down countries are trying to de-dollarize, at the bottom up, people generally still want dollars. That's kind of their fiat currency go-to. And so stable coins are a way to basically get dollars in the hands of people, even as their top level is trying to de-dollarize. So stable coins can actually extend the extent that the U.S. is able to.
In the evolving landscape of global finance, currency diversification is becoming increasingly significant, driven by shifts in international trade dynamics and central bank policies. One key trend is the potential rise in bilateral trade agreements among major foreign countries. These agreements are likely to influence currency pricing by promoting the use of multiple currencies in international transactions rather than relying predominantly on a single currency, such as the US dollar. This diversification in currency usage can lead to a more balanced and resilient global trade system, as it reduces the risk associated with exchange rate volatility and dependency on one dominant currency. In parallel, central banks around the world are reconsidering their reserve asset strategies. Traditionally, treasuries, particularly those issued by stable and economically powerful countries, have been the primary choice for reserves. However, there is a growing inclination towards holding more gold as a reserve asset. This shift is largely attributed to gold's historical role as a stable and universally recognized store of value. Unlike treasuries, which are subject to the economic and political conditions of the issuing country, gold is perceived as a more secure and less volatile asset. This trend suggests that central banks are seeking to diversify their reserves to mitigate risks and enhance financial stability. Overall, the convergence of these trends, enhanced currency diversification through bilateral trade agreements and the increased holding of gold by central banks, reflects a broader movement towards a more diversified and resilient global financial system. These changes are poised to influence future economic policies and international trade practices, fostering a more balanced and secure economic environment.
Maintain some degree of kind of global reserve status, and people can think that's good or bad, but it's just kind of a factor that potentially extends it in the face of that kind of top-down de-dollarization. And so that's all the kind of big moving parts there. But basically, it kind of shifts to a more and more multipolar kind of reserve asset and bilateral trade agreement world. As far as what assets to own, generally, where possible, you short fiat currency, if you could, especially if you locked them in before rates went up, and then you own things that are scarcer. And then if you want to avoid tail risk, you diversify because, for example, you don't want to have everything in one asset and then your asset became the scapegoat that got like an 80% tax put on it, for example, right? So it's not about maybe the asset itself does fine, but maybe you in your jurisdiction don't do fine with that asset. And so you either pay attention to what's happening in that area, or you own, for example, you might own your own house. You might then own Bitcoin. You might own a little bit of gold. You might own some energy equities, or you might own various equities that have locked in long duration rates, and then they have variable pricing power. And that could be in almost any industry. And so you own kind of this playbook that can get through things. Maybe if you want to have if you're older and you want to have lower volatility, you own things like T-bills or intermediate term tips, rather than owning long duration bonds. Those are all kind of the different levers that someone can pull depending on where they live, what is their volatility tolerance like, what is their willingness to kind of concentrate and take on risk of that concentration, which could come politically as well. But basically, yeah, you want to own scarcer assets and be very careful about owning anything that's kind of just purely paper-based.